Hi guys, it's Nishi Patel. So in today's video, what I want to talk about is why people put property into limited companies. I know normally I talk about business and growth, but what I'm going to do is I'm getting a few questions here and there from business clients about why this kind of stuff happens. So I thought I'd just film a couple of videos on the tax side of it. So before I go into that though, just remember, if you go to our website, naccounting.co.uk, we've got information about our quarterly planning day. So if you're sitting there and you don't know how to grow your business, but you really want to, then coming to our quarterly planning day is an absolute must, because you'll get in touch with the right kind of people. And also you will walk away with a solid plan of what you need to do next to grow your business. Our website also has lots of other really useful content that you can use to grow your business, and lots of useful resources. So going back to this video, why do people put properties into limited companies? Well, if you're a high rate taxpayer, let's say you've got a job and you earn a certain amount of money, then if you were to buy a property personally, you could end up in a position where you'll pay high rate tax on that property income, and then on top of that, you also get penalised on a lot of the finance and mortgage costs relating to that property as well. So it's not, when you're a high rate taxpayer and you can't control your income, it's not great to own that property personally. But one thing I'd say is, if that applies to people with jobs, if you're a business owner and you can actually control your income, because let's say you've got property income coming in, you might just take less dividends, right, and let money build up in your limited company instead. And money building up in your main trading company can be really efficient because you can claim entrepreneurs relief on it later on. But let's say you're a business owner and you're either in a position where you can't make do on less than 50k a year, or if there's two of you, 50k each, and but you don't want to pay the high rate tax on that property either. So what you might actually do is come to the conclusion, okay, well, I don't want to own this property personally, I'm going to own it through another limited company. So what the term I'm looking for here is called SPV, special purpose vehicle. It's a special company you set up just to hold a property, but there's a couple of advantages doing it through a limited company. And the main advantage, it's not actually the tax savings, because in a limited company you get taxed at like 20% on the profit you make on that property, whereas if you're a high rate taxpayer just owning it personally, you get taxed at 40%, and it'd be even worse when you lost some of the tax savings on your finance costs. So owning a property through a limited company can be more tax efficient because you get taxed at a lower rate. But where it's not tax efficient is you actually get taxed twice when you sell the property, because when you own that property personally, you sell that property, you make a capital gain, you get your capital gains allowance, although that's going down, but you make that capital gain, and then essentially you get to keep the money after you pay that capital gains tax. When you sell that property through a limited company, you end up having to pay corporation tax on that gain. Then you've got the money left over in the business, which you then still got to get out as a dividend. So you might pay dividend tax to get it out, or you might have to wind that company up and pay like capital gains anyway. So limited companies are good because you pay less corporation tax than you would income tax, but they're bad because you pay tax twice when you sell that property. You may never sell that property, you might pass the shares in that company over to your kids or someone else in your family, so maybe that's not an issue. The main advantage of that limited company and owning a property through it though is because you don't have to take money out of your limited company and pay high rate dividend tax on it. The money can be loaned from your business to this SPV that you've created to hold that property by an intercompany loan, and that intercompany loan is tax-free. So if you took the money out of your business and then lent it to this new property company, or you took the money out of your business and then bought a property yourself, you'd be paying all that dividend tax. By doing that intercompany loan, you're saving a load of tax, and essentially then you've essentially saved a load of money just up front, and then you put that into the new company to buy the property as a deposit, and you get a loan, you get a mortgage on that SPV. I guess I've covered a lot of stuff here, a few things to consider. Yeah, I mean, I guess to summarize, yeah, it's when you are a high rate taxpayer, putting into a property company, getting a rental property through a company can be really beneficial. But also there's a downside when you do come to sell the business. And one thing to factor in, SPV mortgages tend to cost more than having a mortgage in your own personal name. So, and also if you don't discount getting a commercial property through your pension as well, because if you are thinking of investing in commercial property, doing it through a pension scheme, if you've got the money in your pension to do it, can be really favourable as well. Especially now, you can put more money into pensions. So that is a lot of information that I've just thrown at you. So if you do want to talk about any of that, and then just get in touch. You can go to our website, naccounting.co.uk, book yourself in for a phone call using the strategy session link, and don't forget to check out our other great content, and I'll see you at the next video.